on board. Let's get an overall sense from you as to what we're expecting in terms of the festive season push from the earnings sector, from the earnings as well this time around.
Hi, thank you for having me on the show. Good morning. So as far as the Q2 is concerned for the auto sector, clearly we are seeing passenger vehicles and commercial vehicles have delivered a pretty decent growth, about 8 to 7% growth. Two-wheelers and tractors continue to lag. Two-wheelers have seen about a 3% decline, and tractors have also declined year on year in this year, right? So which means those companies will face some earnings pressure. In terms of earnings surprises or earnings improvement over on a sequential basis, what we are expecting is players like Maruti Suzuki, for instance, will do very well in earnings this quarter for the simple reason that the UV mix for Maruti has improved substantially. UV mix in Q2 stands at 33% relative to 25% last quarter, which means that there will be a relatively much improvement in margins. We expect a 130 basis points margin improvement for Maruti this quarter, which should help earnings growth overall for Maruti. Coming back to two-wheelers, within two-wheelers, the best place seems to be TVS Motors, which has delivered almost a 12% kind of a growth this quarter, and of course has outperformed industry as always. TVS is expected to lead the pack with a 15% earnings growth in the two-wheeler space, according to us. Players like Hero MotoCorp and Eicher Motors, for instance, are likely to face some margin headwinds for the simple reason that we expect ad spend or promotional spends to normalize with the new launches this quarter, which should mean that those players will see some margin headwinds this quarter on a sequential basis. Coming to commercial vehicles, clearly Ashok Leyland and both Tata Motors in the CV space will deliver a pretty decent set of numbers in terms of sequential earnings improvement because they have seen a pretty decent sequential volume growth. That's largely the take on OEMs from us.
Aniket, you think the bigger move or surprise would come in from tires within that? Because, yesterday we saw a great performance from CEAT, and the management, actually, we spoke with them yesterday, are pretty confident that even with the RM basket uptake, they will be able to hold on to their margin range. Do you think that's the space that one needs to be in?
Right. So CEAT has certainly surprised positively in terms of numbers, right? If you look at CEAT margins, they have improved 200 basis points clearly on a sequential basis because the raw material basket declined 2% sequentially while they were able to hold on to the prices. So clearly, I think tire space looks pretty decent at the moment, yes. But at the same time, one has to also see on a stock specific basis, right? Because a lot of tire stocks have also done well in the recent past. Names like a CEAT and even MRF has rallied quite a bit. So within the tire space, we still like Apollo Tires, which has sort of underperformed a bit related to peers, but the performance continues to be upbeat for Apollo. So within the tire space, I think Apollo remains our preferred pick at the moment.
Are also looking at building up the inventory in anticipation of festival season. That is what Maruti told us, and that is what we are getting a sense from other car companies. But there is a what if. What if sales are not strong? What if footfalls are not strong? What if consumer does not come back? Is that a risk from a market standpoint also to auto stocks, that what if happens?
Very rightly put, Nikunj. For instance, for passenger vehicles, right, you still have a pretty healthy order backlog. To that extent, even if stocks are there, I think they will get liquidated very soon. I think for players like Maruti, they have already liquidated their slower moving inventory, which is the cars category, or rather, I would say they have sort of lowered their inventory in the car segment. And for UVs, you would be aware there's a very healthy waiting period across the board, be it Maruti, M&M, even Toyota, Tata Motors, etc. So everybody is seeing a very upbeat kind of a demand momentum in utility vehicles. Coming to two-wheelers, for instance, yes, there is a clear risk that if demand does not pick up, there could be some inventory pile up, especially in the entry-level segment, which is still lagging behind, right? The rural segment has not recovered yet, and that would mean that if festive season is not what OEMs are expecting, we could see some inventory pile up for sure within the two-wheeler industry. So I think two-wheelers could be at risk relatively related to passenger vehicles.
In last 2 years, and specifically if I look at last 2 year data, Tata Motors has hit out of the park, TVS Motor has hit out of the park. Similarly, the old economy companies, when I say old economy, Maruti is old economy for me because they are not moving to EV. Hero Motor has done nothing. They've underperformed. Do you think now it's time to flip, where this entire EV dominated auto stocks could take a backseat and the traditional ICE engine auto companies will make a comeback?
So specifically, if you were to ask me between Maruti and Hero, since you mentioned relatively slower on the EV run, I think Maruti is doing relatively much better than a Hero MotoCorp, for instance. Like if you were to look at UVs where Maruti was lagging, they are already have improved their market share in the second quarter to 28%, and for H1 their market share stands at 25% now, which is much higher. In FY23, you would recall they were as low as 12%. So they are ramping up their presence in the utility vehicle space, which has been outperforming recently. So Maruti seems to be doing very well related to peers, and EV transition in passenger vehicles has not yet picked up. So to that extent, Maruti has not been as impacted with EV transition relative to what two-wheelers have faced, right? Coming back to Hero MotoCorp, for instance, Hero MotoCorp, as you rightly pointed out, in terms of new launches, while they have seen a slew of new launches, but market share recovery hasn't happened yet for Hero MotoCorp, even as we speak, right? In Q2, they saw Extreme 160R getting launched. They saw the new Passion launch. They saw new Glamour launch, and they have just recently launched the Charisma as well, right? Despite the new launches, we have not seen any market share uptick for Hero MotoCorp, which continues to be a concern, and which is the reason we are have a reduced rating on Hero MotoCorp at the moment. So the pain in Hero MotoCorp is the fact that the entry-level segment is not doing well, and the segment that is doing well, Hero is underperforming that category.
Okay, Aniket, great to have you on the show. Thank you so much for taking the time out and joining in today.